Welcome to your tax and accounting guide. In this detailed guide, we'll explore essential tips and strategies to help you navigate the complexities of rental property taxes. Whether you're a seasoned landlord or just starting out, understanding how to manage your rental property taxes effectively can save you money and reduce stress. Let's get started. 1. Understand rental income. All rental income you receive is taxable and must be reported on your tax return. This includes rental payments, regular payments from tenants, advance rent payments, rent paid in advance, security deposits if not returned to the tenant, expenses paid by tenants, any expenses tenants pay on your behalf. 2. Keep detailed records. Maintaining accurate and detailed records is crucial for maximizing deductions and ensuring compliance. Keep track of rental income. Document all sources of rental income. Expenses. Record all expenses related to the property, including receipts and invoices. Lease agreements. Keep copies of all lease agreements and amendments. 3. Deductible expenses. You can deduct various expenses related to your rental property, including mortgage interest, interest paid on loans used to acquire or improve the property, property taxes, annual property taxes paid to local governments, repairs and maintenance, costs of repairs and maintenance to keep the property in good condition, insurance, premiums for rental property insurance. Utilities. If you pay for utilities, these costs are deductible. Advertising. Costs of advertising the rental property. Professional fees. Fees paid to property managers, accountants, and legal advisors. 4. Depreciation. Depreciation allows you to deduct the cost of the property over its useful life. The IRS allows you to depreciate residential rental property over 27.5 years. To calculate depreciation, 1. Determine the basis. The basis is the cost of the property, including purchase price and any improvements. 2. Subtract the land value. Land cannot be depreciated, so subtract its value from the basis. 3. Divide by 27.5. Divide the adjusted basis by 27.5 to determine the annual depreciation deduction. 5. Repairs versus improvements. It's important to distinguish between repairs and improvements. Repairs. Costs to keep the property in good condition, e.g. fixing a leaky faucet, are deductible in the year incurred. Improvements. Costs that add value or extend the property's life, e.g. a new roof, must be capitalized and depreciated over time. 6. Home office deduction. If you manage your rental properties from a home office, you may qualify for the home office deduction. To qualify, exclusive use. The space must be used exclusively for business. Regular use. The space must be used regularly for business activities. 7. Travel expenses. You can deduct travel expenses related to managing your rental property, including mileage. Keep a log of miles driven for property-related activities. Lodging and meals. If you travel overnight for property management, these expenses are deductible. 8. Qualified Business Income Deduction, QBI. The QBI deduction allows eligible landlords to deduct up to 20% of their qualified business income. To qualify, the rental activity must be considered a trade or business under IRS guidelines. 9. Passive activity loss rules. Rental activities are generally considered passive activities. Passive losses can only be deducted against passive income. However, there are exceptions. Active participation. If you actively participate in the rental activity, you may be able to deduct up to $25,000 of rental losses against non-passive income. Real estate professional. If you qualify as a real estate professional, you can deduct rental losses against other income. 10. Tax planning strategies. Effective tax planning can help you maximize deductions and minimize tax liability. Bunching deductions. Pay multiple years' worth of deductible expenses in 1 year to exceed the standard deduction threshold. Deferring income. Delay receiving rental income until the following year to defer taxes. Accelerating expenses. Pay expenses in the current year to take advantage of deductions sooner. 11. Consult a tax professional. Tax laws are complex and constantly changing. Consulting a tax professional can help you navigate the intricacies of rental property taxes and ensure you're taking full advantage of available deductions and credits. They can also provide personalized advice based on your unique financial situation. Conclusion. Managing rental property taxes requires careful planning, detailed record keeping, and staying informed about tax laws. By implementing these tips and strategies, you can reduce your taxable income and potentially increase your tax refund. Remember, consulting with a tax professional can provide valuable insights and ensure you're making the most of your deductions. Thank you for tuning in to your Tax and Accounting Guide. Stay informed, stay organized, and maximize your tax savings.